Harvard's financial report for fiscal year 2025 reveals a concerning trend. The prestigious university has reported its first budget deficit since 2020, a staggering $113 million loss. This comes despite an 11.9% growth in the total value of its endowment, now standing at $56.9 billion. The deficit, a 1.7% operating shortfall on $6.7 billion in revenue, is a stark reversal from the $45 million surplus in the previous year. It's a direct result of the Trump administration's decision to terminate nearly all federal research grants, a move that has shaken Harvard's financial footing. A controversial move with long-term impact. While most of Harvard's funding has been restored after a federal judge ruled the funding freeze unconstitutional, the impact of this disruption is far from over. The 2025 report, which covers the fiscal year through June, doesn't reflect the reinstatement of funds. Furthermore, the realized gains on the endowment in fiscal year 2026 will be taxed at an unprecedented rate, over 400% of the current rate. Harvard's last reported deficit was in fiscal year 2020, a $10 million shortfall due to the COVID-19 pandemic. This year's deficit, however, is a different story. Harvard's leadership attributes this financial strain to deliberate federal policy, not a public health crisis. Harvard Treasurer Timothy R. Barakat, 87, and Chief Financial Officer Ritu Kalra wrote, "The financial consequences of the White House's attacks on Harvard are only beginning to be felt." They highlight the quick and resolute actions taken by the university community, including cost-cutting measures such as pauses on wage increases, layoffs, and a university-wide hiring freeze. Austerity measures and their impact. Despite these measures, the university's operating expenses still rose by $367 million in fiscal year 2025. The increase was driven by salary and benefit hikes prior to the hiring freeze, legal fees, and investments in technology infrastructure. Barakat and Kalra credit the strong investment return on the endowment, the highest since the post-pandemic economic recovery, as a key factor in navigating the uncertainty caused by the White House's actions. University President Alan M. Garber, 76, expressed gratitude to donors and Harvard affiliates for adapting to the uncertainty and threats to sources of revenue the university has traditionally relied upon. He acknowledged that fiscal year 2025 was extraordinarily challenging, with political and economic disruptions affecting higher education. The endowment accounts for 37% of the university's operational revenue, resulting in a $2.5 billion spend in the past fiscal year. The university also utilized $250 million in contingency reserves to support researchers during the period of federal payment reinstatement. However, Barakat and Kalra caution that the endowment cannot be used indefinitely as a stopgap measure, as 80% of its funds are restricted and cannot be reallocated at will. A rebuke to criticism and a shift in strategy. Harvard's federal-sponsored revenue fell by 8% to $629 million in fiscal year 2025, a direct result of the suspension of federal research grants earlier in the year. Without these grant freezes and cuts, federal-sponsored revenue would have increased by 9% over the previous year. Non-federal sponsored revenue rose by 6% to $345 million, driven by new multi-year awards. The strong returns on the endowment, which increased its value for the second consecutive year, serve as a response to criticism of Harvard Management Company's, HMC, historical underperformance. Under the leadership of HMC CEO N.P. Narvekar, the fund management team underwent a dramatic restructuring, shifting towards external managers and private equity holdings. This shift has paid off, with HMC seeing the highest return rate since Narvekar's term began in 2016. However, a major challenge looms for Narvekar. The Republicans' megatax and spending bill, signed into law in July, raises the highest tax rate on endowment returns from 1.4% to 8%. If applied to the endowment's most recent returns, This tax would cost the school approximately $300 million for the most recent fiscal year. This story is a reminder of the intricate relationship between politics, economics, and higher education. It raises questions about the sustainability of universities' financial strategies and the impact of political decisions on academic institutions. What are your thoughts on this matter? Feel free to share your opinions in the comments below.